The broadcast is now starting. All attendees are in listen-only mode.
Hello, good morning everyone. I can see a few people here and let's wait for a couple of minutes because this is just 11 and a few people are more expected to join. Go to webinar takes a minute or two to join. So let's wait for a minute or so and then we can start off. I hope you guys can hear me. If yes, please send it in the comment box. Please send it in the comment box if you are able to hear me. All right, thank you. Okay, let's get started. Yeah. So, good morning, everybody again. This is the first webinar we are holding ever. In fact, I'm, uh, you know, handling this webinar tool also for the first time, so I'm also exploring how it works and all. So, pardon me for any mistakes if there are any during this period. And I know that this is Sunday morning, weekend time plus Sunday. So I'll keep it as crisp and as quick as possible. So I hope you can also see my screen. I'm sharing it. Just a quick yes would help. All right. I will be reading your comments as well. Thank you so much. Okay. All right. So this webinar is about bringing in efficiency in our entire trading as an investment process, and getting maximum benefit out of what we do. Right. We don't want to just spend time 3 months, 6 months, 1 year, 2 year on something which doesn't give us much of return. How can we maximize things with as little efforts as possible? This is something that we're going to be discussing today, and we all know that we have our model, which is a directional model. Uh, the most you know the the feature of this particular model is that it tracks the entire options players in the market, right? So it's pretty powerful. Options players, as you know, that it is the most powerful. They are the most powerful people, and they display a huge amount of impetus on the market on both sides. So our model tracks the movement of these options players through the options chain of various expiries, and then tries to identify where people are trying to take the market, right? So it's pretty powerful, and it is ageless because options players strength will never go away. It is not unlike other systems where due to volatility things may change for a very long period of time. This model works pretty differently. So how can we use this model to scale up our entire book, right? So because trading, if we consider it as a business, how can we run it as a business? How can I run it as a business? How can you, as a user, as a subscriber, as a trader, can use it as a business in itself, right? So we will be talking about that through the scaling up technique. So what is scaling up? So let me, before um, explaining you, in the next couple of slides, it will get very clear what is scaling up. But let me start with what are we trying to achieve, right? Because that will set the expectations with all of you, right? So let me show you this particular slide in which the graph tells you that set one, right? The first slide, the set one, uh, the deployed capital is 10 lakh, right? The deployed capital is 10 lakh, which means that we have deployed 10 lots of Nifty, right? What is the initial capital for 10 lots, 10 lakh? Uh, the initial capital kept is 20 lakh, right? Which is double. So which means that if you have a capital of 15 to 20 lakh, so this is just a multiple, right? So you can have a lesser capital or far more greater capital than this. This is just to give and overview. Just a second, a few people are also trying to reach out. Just give me a second. There are a few people trying to join. Right. I'm really sorry for that. So yeah, so if you've got a capital of 15 to 20 lakh, right, and you deploy only half of it, right, and you keep half in cash, right. So that's very important. If you keep, if you have got a capital of 15 lakh, that's also fine, but better would be 20 lakh, right. But you deploy only 10 lakh, right, which means that you are taking a risk of only 10 lakh, right. Now, once you start trading the model and once you get a profit of 10 lakh, which means that your ending capital is 20 lakh, right? Which means a profit of approximately 10 lakh, you withdraw that money. That's extremely important part. As a part of your business, what you would like to do is withdraw the money whenever you get it, right? You may get it in 3 months, 6 months, 8 months, 1 year, but it's important that you withdraw the money and do not risk that money again on the same thing, right? Which means that at the end of the period this period, you have 30 lakh capital in your account, right? Now what you do is 10 lakh rupees you withdraw into your bank account, or you want to do some kind of stock investment or any kind of mutual fund investment or PMS investment, you can do with this 10 lakh, or I would suggest you buy ETFs out of it, but you withdraw this money, right, and keep it safe. Now you come back again to 20 lakh, right? You start again back from where you started. So you're starting with 20 lakh capital again. You're deploying 10 lakh, right? Which means you're starting with about 10 lots again. Again, you continue doing it, you will start getting returns again, and you will end up soon with 10 lakh profit again, right? So again, you will go back to 30 lakh total capital, you withdraw that 10 lakh again, and then again, so it's a cycle you keep repeating. So every time you get a profit of 10 lakh, you withdraw that money and start from where you would want to start, that is 10 lot, right? And you keep doing this cycle. So this sheet is a backtest or a projection of last 2 years on our model, right? With this particular scaling up technique. Let me tell you one more thing, that this technique has come out only now. It is not that we were training it earlier. This is something that, one of our well-wisher, a friend of mine, Hitesh, he's also using the model. He came up with an excellent, technique. He said that the model has a tendency of remaining at a high for a very long period of time. This can be scaled up to greater extent, and he created an Excel sheet and showed it to me. I just made certain more modification from a risk perspective, to start withdrawing, the capital, and do not risk everything in one particular model itself, right? Uh, Also to tell you that this is not the last webinar that we'll be doing. We'll be doing another set of webinars where we will talk about how people are using the model in different ways. Some people are trading it using futures. Some people are trading it using buying options. Some people are trading using, selling, option selling, right? Naked option selling, or for that matter, um, spread or through some straddles and all. So we will take more sessions, more webinars on what are the different ways that you can trade on the model to maximize your returns over a period of time, right? It all depends upon the capital that you have and the risk appetite that you have, and your entire risk management that you have created in your entire portfolio is how you will decide what you trade, right? So as of now, this is what we are going to achieve at the end of the scaling up method, right? That you double up your deployed capital, withdraw the money as a profit, use it for your own purpose, or reinvest it, then again keep doing that cycle again and again, right? So this is the objective. If once this objective is clear, things become really very clear. Just give me a second. Yeah. So you guys have any question as of now, or anything that you would like to ask during the presentation? Please, put that in the chat. I will also unmute you soon, and then let you ask your question through your audio, right? But let me just cover a couple of more slides here. Now, what are the rules of the scaling up technique, right? So, like I said, start with 5 or 10 lots depending upon the total capital that you have. If you have a 20 lakh capital, then start with 10 lots. If you have 10 lakh capital, then start with 5 lots, right? Which means that you are not putting more than 50% of the capital in trading it, right? So this is the first step, right? Second step is that every lakh rupee of profit, you increase the position size by 1 lot, right? That's the second rule. Third rule is every 1 lakh rupees loss that you incur, you decrease the position size by 1 lot. Now, this is important because you want to keep the risk at check, right? This is important. So we will be covering that in the next couple of slides. And the fourth rule and the final rule, it's very simple. All of these are very simple. Is that once you have doubled your deployed capital, withdraw the profit and start from the step one. Right? Very simple, very clear. All calculations are based on the at the end of the trade closure, right? So if 1 lakh profit uh, is reached when the trade is on, that is not to be considered. Let the trade get completed, let the trade get exited, and only then you should do your calculations to increase or decrease the lot size. Right? So that is another. There is a possibility that when the volumes are higher, your profit will jump suddenly by 2 lakh rupees, right? So if your profit jumps by 2 lakh rupees, and this has happened earlier as well, in one single or in just two trades, then you have to increase your position size by 2 lots in the next trade, because like the rule number 2 is every 1 lakh rupees increase in profit, you will increase by 1 lot, right? So if suddenly one trade gives you 2 lakh rupees profit, then you increase it by 2 lots, not one single lot, right? So that's one important thing. If you have a loss of 2 lakh, then decrease the position size also by 2 lots, right? So these are the rules. Now I understand that it will not be very clear to you right now. What I will do is I will show you a grid, right? And after this grid, I will take real trades for the past 2 years, divided into multiple sections, and show you all those sections, right? So don't worry, it will be very clear by the end of this slide. So the position sizing grid says that if you have started with 10 lakhs, right? So which means that you have started with 10 lots, right? If your profit goes between 11 lakh to 12 lakh, 11 to 12 lakh, right? So you increase the position size by 1 lot. Between 11 to 12, you increase the position size by 1 lot. Then between 12 to 13, you increase the position size again by 1 lot. Right? Then 13 to 14 again by 1 lot. 14 to 15 again by 1 lot. So by the end of 19 lakhs, you will be trading around 9 lots, right? The initial 10 lots plus 9 lots, which means that you will be at 19 lots, right? And once you have your capital reaching 20 lakhs, which is 10 lakh profit, which means that next you have to trade as 20 lots, right? That is the time immediately you stop, you withdraw that 10 lakh rupees back into your account and go back to 10 lakh rupees, right? That's the idea. Now, what happens if you start and your position goes down, you start getting losses? What do you do? So if the position size in your next trade goes below 10 lakh, you reduce your position size by 1 lot. Right? Immediately below 10 lakh, you reduce the position size by 1 lot. If it goes below 9 lakh, then you reduce the position size by another 1 lot, which means that earlier when you started with 10 lots, now you'll be trading 8 lots, right? So I hope it is clear by now. I will be sharing this as well. Give me a second. How many lots were traded for capital of 20 lakh? So it is 10 lakh, 10 lots, right? So 10 lots, let me show you again. So this is the grid. Initial capital is 20 lakh, right? So we start with 10 lots only, right? So this is it, and then we scale up as we get profit, right? 1 lakh profit, we scale up by 1 lot. So it will become 11, 12, 13, 14, but we start with 10 lots for 20 lakh. If you have lesser capital, like you're starting with 10 lakh capital, right? Total capital as 10 lakh, then you have to trade not more than 5 lots, right? Right? So that's it. And the next question, based on this projection, if you do withdraw 10 lakh every time, we could be sitting on very high amount. 10 lakh. Will be 20. I really did not understand this question, but this is from Rushit Shah. Rushit, I will unmute you. You please ask your question in detail by voice. You are unmuted now, right?
So I was wondering, I got the clarification in your second slide, so it's fine now. It's not
Okay.
that with 10 lakhs we are getting 20. It's every time you add one and then we reach 20. So
Yeah.
it's clarified. Thank you.
All right. Correct. Great. Thank you. Okay. Let me move ahead. Now I will show you the Excel sheet itself. Now this Excel sheet is not out of air. Okay. These are real trades, right? And these are the performance trades. So I have this sheet, the model one month wise. We've taken it for last little over 2 years, right? We did not take the pandemic Feb, March, April because that was extreme and the model gave around 300, 400 to 3 to 5,000 points within a span of 3 months, which is extreme. I don't want to consider as a part of the performance at all. So we have started taking it from June onwards, right? So the ending trades from June series. So this is June series, June 2020 till July 2022, which is last month, right? So this contains all the trades. I will share the entire sheet with you, right? So now let me start the sheet one. So we started in June 2020, right? So we started with what? We started with 10 lots, right? We said that, you know, we have 20 lakh capital. We're starting with 10 lots. Now, if you see, this is the buy, this is a short, and this is the shorting rate, and this is the buy rate, and this is the profit and loss, right? After this particular trade. This is the model performance. But what about cost? Because you'll be bearing some cost, right? The brokerages, the taxes and all, right? So we have considered some 3 points as brokerage and taxes as per Zerodha's tax brokerage calculator. It shows that you to break even you need 3 points, right? So we have reduced from each and every trade 3 points for taxes and brokerages. Now, what about slippages? So slippages is a big problem, right? Everybody has this problem, and that is what we at the end of the session we'll be covering how to reduce the slippages and increase our potential, right? What about slippages? Slippages is a part. So we have also considered profit and loss as a slippage. Now we have considered a huge slippage cost here, right? Huge, which means that 20% slippage we considered, if you see, right? Which means that if the model gives 15 points, then according with slippages and cost, we are taking only 10 points, right? Which is like nearly 30%, probably more, right? If you see, a model gave 624 points, but for our calculation purpose, we have reduced with slippages, and it will not be this much. Let me tell you very frankly, it will not be this much. But just to be on a safer side, to give you very realistic and more than realistic picture, we are considering this as huge slippages, right? Now only 500 points, right? What is 500 points? Which means like another 20-25% less we are considering. Now, what about the loss-making trades, right? So if the model is making minus 56 points, so let me just make it a little bigger, right? Yeah. So if the model is considering taking minus 56 points, then we are considering that we got a little. Okay, there's a little mistake here, little mistake. But anyways, this is going to negate everything. But overall, if you see the profit, the total model points that it made was 2,400 points, right? And with slippages and cost and everything, with huge amount of this thing, we are considering this only 1,700 points, right? Which is more practical, and this is what we keep getting in our real accounts also, right? So in the set one, we are considering the total model performance as 3,000. With slippages, we are considering 1,900, right? So which is like 30% less profit we are considering. Here we are 2,700 points with slippages, and we are considering it 1,900 points. Currently, the one which is going on. So if the model is given 1,400 points, we are considering only 700 points, right? From March onwards, right? Which is like almost 50% reduction in the profit from the real model performance. So this sheet is pretty practical if you see. So let me take one random sheet which is number 4, right? So here if you see we are starting with 10 lakh. Don't consider this for first line because this is a blank, only for the calculation purpose. But the real trade starts from the second one. And you can see it in the dates as well, right? So we are starting with 10 lots here, right? Which is 10 lakh capital, right? And here the configuration here, because I'll be sharing this sheet with you for you to do the hands-on. Uh, we are saying that every 1 lakh rupees profit up, we will be adding up a profit, adding up a lot, and 1 lakh loss will be reducing. So this is the configuration of 1 lakh. Now for our model, this configuration is the best configuration. If you reduce it to 50,000, then you might not get good results, right? Scaling up also has some parameterization. You cannot, use any number, any value for any kind of system, right? So it has to be backtested. It has to be seen in an overall context, right? So that is so this is the configuration. These are the two configurations, right? Let's say that you have uh, 10 lakh capital and you want to trade with 5 lots, yeah, and which is 5 lakhs, right? So if you change this to 5 lakhs, the entire calculation also changes, right? So this is how uh, you can use this sheet to do your own calculations and manage your own position sizing, right? So this is the tool. This is a tool which will help you identify how many lots you should increase, reduce, and at this time in this particular trade, how many lots you should trade, right? So now coming to explaining the trade, right? So if you see the first trade, it gave a profit of 8,000 rupees. The capital went to 1,04,000 rupees. The quantity is the same, right? So many trades passed, and if you see till this point, um, uh, till this point, the profit was 68,000, right? Then suddenly one trade, the profit came to 49,000, and the capital crossed. You see this capital crossed. Um, Sorry, it is here. So the capital crossed 11 lakh, which means that we got one additional lakh rupees profit, right? So immediately we need to increase the position size by only one lot, only one single lot, right? So we increase the position size to one lot. If you see again here, if you see in this particular trade, we got 4 consecutive losses. The profit went down below 11 lakh right here. So we immediately reduced in the next trade position size by one lot. Right? So we came back again to 10 lots. Then again it went above 11 lakh. We again went to increase by one lot. Now if you see this trade, we got a sudden profit of 1 lakh rupees on 11 lot. So the capital crossed 12 lakh. So we increased another position by one lot, right? And this kept happening. We just identify here. If you see the sudden profit of 1,70,000, so we increased the position size by one lot again, right? Here we are on to 700 or 14 lots, right? Then again the profit dropped, so we got 3 consecutive losses. So profit dropped and went below 14 lakhs. So again we reduced by one lot, right? So this keeps happening, right? This keeps happening, and you'll find that 1 month, 2 months, 3 months, it is just happening, and suddenly one fine month the model performs big time, and suddenly you find that you are started to trade uh, 15 lot, 16 lot, 18 lot, 19 lot, and suddenly it gives you a profit of you go to nearly 20 lakh, right? 20 lakh capital, which is 10 lakh, 10 lot profit, 10 lakh profit, right? 10 lakh profit after all the slippages and costs and transaction costs and everything. And if you are incurring any charges, like you have to pay for us to execution and all those things also, you will be you are getting covered out of it, right? So this is where you reach. stop trading here, right? Stop trading here. In the next trade, go back to 10 lots, right? Start trading the next trade onwards, 10 lots. Yeah, and continue and continue and continue and continue. Right now, let me show you month wise, right, or period wise. Right? So in the last 2 years, we had 5 sets, right, of 10 lakh each in the last 2 year period, right? So in the first period, which started in May 2020, a lot of you folks were also actually not trading during this period. A lot of you folks actually started after 2021, but we have traded this not with scaling up, but we have traded this. This was a period when the profits were very, very high, right? Exceptional periods, exceptional days, exceptional years, right? So from 500, it very fast went all the way up to 1 lakh in just a period of 3 months. Right? In 3 months, with scaling up, it went up to 10 lakh. Right? So on 4th August 2020, right? So we stopped. We have to stop. We go back and start trading the next series, which is 5th August onwards. Right? Again back to 10 lots. Right? So it, again same thing. Now let me show you this is important, right? The drawdown period. So the reason why we have to reduce the lot size also is to keep the total risk in check. See, remember, you started with 20 lakh. Okay, this is what is there in your amount. You deployed only 10 lakh. Okay, right? This is and now from the first trade itself, you are undergoing a drawdown, right? So you started with 10 lots, now you are down to 9 lots, right? So your profit goes down further below 9 lakh, right? Here, right? So you reduce one more lot again, right? So you are down to 8 lots. The profit goes below 8 lakhs now, right? So you are down to now 7 lots. Now what is the total loss that you have incurred here? 2 lakh rupees, right? 2 lakh rupees you have incurred loss. Now 2 lakh, and if the model goes down into the drawdown further, you'll be reducing the position size further, right? Even if it goes to like 200, right? You are reducing it to 200, which means that you still have 10 lakh in cash, right, to trade if any eventualities happen, and continue with trading this model. So your business, consider it as a business, your business will never stop, right? So 2 lakh, the maximum drawdown that we had undergone during this period was 2 lakh, right? What is 2 lakh out of your total 20 lakh, which is only 10%? So probably you can kind of, um, it's okay for you to consider these kind of drawdowns. If it is like 30 lakh, 40 lakh, so it might be like 3 lakh or 4 lakh rupees, right? So which is absolutely fine, but it keeps you in the game, right? To continue to trade, and that's what exactly happened, right? So if you see, you were down to 7 lots only, right? 2 lakh down, and then if you had continued to, uh, perform the same activities, follow the same rules with all the slippages and costs, everything, and have patience, the most important thing, patience, right? See what happens then later on. After a few months, after 3 months, suddenly, right, in just 1 month, you reach your entire profit target, right, which is 10 lakh. So what is important here is that you will have a long period where the model or your returns may not come, but don't worry about it. Continue to follow the rules, continue to follow the process, continue to do what you are doing, and the day will come when you will have your targets reached, right? So at this moment, if you see the current month, right? Let me go back to the slide and show you. So this is the real performance. The first set took only 3 months to reach the profit target of 10 lakh. Second set took 6 months, then 5 months, 5 months, 5 months. And here, if you see right now, it's the worst period that we have encountered, right? It's been 5 months and we do not have a profit, right? What does this mean? This means that the potential of model doing and potential of you reaching that target now is very, very high because the model has done its entire drawdown phase, right? So we started in March. So entire drawdown phase is already done, right? So this was a drawdown phase, and it's all about 10% loss in all accounts you can consider. We are still at some losses, right? But why do worry about it? Don't worry. Continue to do it because soon, someday, probably next month or next to next month, you will have doubled your capital, right? So it's up to this point. It's up to this point. Yeah. Right? So continue to trade. That's more important. The reason for me to hold this webinar is because this is the right time. The model has done its past time, and the probability and potential of it now working is very, very high. So this is the right time to get into the model. In fact, some of our execution accounts, we have already started increasing the position size as per this rule, right? Some of you already know that we have started increasing the position size by one lot because we had a profit of 1 lakh rupees last month. So we have already increased by one lot, and we'll continue to do and follow this rule from now on. So we have started already working on this particular thing. Now what I'll do is let me take some questions at this stage, right? Suresh, you are asking something, but you only wrote, "Am I right?" We did not get the question here written down. So, Suresh, I will unmute you. You can ask the question. Yeah, yeah, Suresh, you are
Be able
unmuted.
to hear me? Okay. Okay. I was just asking you, initially you said 5 lakhs per 10 lakh in the second slide or something.
Yeah.
So there, do you mean to say initially we start with 1 lot per 2 lakh, and then when we scale up, we will be 1 lakh per 1 lot?
One lot per 2 lakh. Yes. On the current margins, that's important, right? So
Okay.
if tomorrow the margins go
Okay.
up to, if NSE increases the lot size by 70 to 75, like it was earlier, right? Then the margin would
Okay.
be 1.5. So you'll need 3 lakh
Okay.
rupees.
So this 1 lakh margin is for the synthetic, you mean, margin wise?
For synthetic or for
Okay.
futures, it's the same. The margin is the same.
Okay.
Yeah.
Okay.
So
Is
any
it
other?
less than 1
Yeah.
lakh?
Yeah.
Okay. Okay. Fine. I understood.
All right. I'll unmute you. Anybody else who wants to raise their hand? I had seen Hitesh. Hitesh, I'm unmuting you. You can ask your question. Or probably you can ask your question. I am unable to unmute you. All right. Anybody else wants to ask question? Is it clear? Can I get yes or no in the comment box, please? If it is clear or you want me to repeat anything, I will be sharing the Excel sheet, the calculator of position size with you. Don't worry. The objective here is that all of you make money. Is it all clear? Shall I move ahead? Anybody? Or people have gone to sleep? Am I audible? Even my people have gone to sleep. It seems. Satish, you have gone to sleep? Nobody is responding. All right, okay. But then you have to respond also, no? Okay. Okay. Ganesh, you have a query. I will unmute you. Yeah, Ganesh, you can ask.
Hi, Junaid.
Hey, hi.
Junaid, you are sharing the results, right, from 29th May till now.
Yeah.
See, you have made your capital from 10 lakhs to close to 50 lakhs right now. And you have passed every 10 lakhs, you have passed that profit in some other instrument or some other model. So is there a time where we can deploy everything back into this model, or is there a point at which you will decide that, or it's always like this?
Good question. Good question. Very good question. Now again, everything depends upon a person's life. So this is where objective comes into picture. So if there are some people who already have second income, or first income. This probably is the second income. There are people who want to make this as a career. There are people who are trying to run this as a business. So everybody, every person in the world has a completely different outlook, right? So this is just one way. According to your risk profile, if you think that you can afford to now start putting initial capital of 20 lakh rupees in this model, 40 lakh rupees in this model, right? Instead of 20, now you say that, okay, I have enough profit. Now let me put 40 lakh rupees and start with 20 lots itself. Let me tell you, there are people on this group also who already trade more than that kind of lot size, right? So they already do. So you can definitely assess your personal life, assess how much risk you want to take. Also assess what is the period of time that we are living in, right? Is there a war around? Is there elections around? Is there recession fear around, right? What life stage you are in? You are young. You have stable job, stable business. You have enough savings. So what stage of life you are in? What stage of life the world is in? Consider all those things, and then you can decide upon taking this to 20, 40, 60, 80. It doesn't matter. Market is pretty big. You can keep increasing it. Did I answer your question?
Yeah, that was clear, Junaid. Basically, my question is right now, if you see the last 5 months, it's in a drawdown right now, right?
Yeah.
Like 55,200. So do you think this is a good time to scale it up or pump in additional capital, whichever you have?
Absolutely.
Basically, if I park it in another model, can I pull it back into this model?
Absolutely. I personally believe, like I said, that we've already started doing that, right? We've already increased a lot of our account position size by one lot, and it has been a historical record. Let me show you the Excel sheet again, right? If you see, this is a period entire from August 2020 onwards, right? August 2020 onwards, it was in pretty long phase of drawdown. August, September, October, November, December, right? 4 months of drawdown, and that 1 month, and nothing happened, not much. It was just hovering around the same value, right? So, and suddenly from January onwards, I think if I remember this correctly, January we got around 1500 points or so. Suddenly, you doubled up your capital. Suddenly, right? So we really never know when this period comes. And right now, at this moment, we've already passed 5 months. Right? Who knows? Next month, the model may give that required 1,000 points or 1,500 points, or next 2 months it gives, or probably it may give in just 2 or 3 trades. That may also happen. So my suggestion here is that don't worry about the number of trades or the number of weeks that pass by. Have patience, because it is just holding up at the highs, right? Around in real account, probably around 10 to 15% loss you may be having because of hedging reasons that we tried doing to protect your account, which was a big mistake. I've been telling this to people that hedging for 3-4 years, it made a lot of money. But last 6 months period, it did not make money. It's okay, it's okay. But then we should not stop using this particular model or this particular fundamental for any other reason. We should continue to do it. Who knows? In just couple of days, your target hits. So please start. And see, the thing is that what is the starting point, right? I took May 2020 as a starting point. What if you start here, right? The calculations would remain the same, right? Calculation will always start with 10 lakh 500, right? So no matter where you start trading a model from, it is always starting with 10 lakh or 10 lots. Right? So you can start anytime, and this I believe is the right period to start. No worries at all. And that's the reason why I'm holding this webinar also in an emergency, right? Because I thought that this is the best period to start. Yeah.
Thanks, Junaid, for the clarification.
Great. Okay. Okay. So Abhi Dugar has asked, this backtest is of futures pricing or of synthetic futures, right? So this backtest, this is not backtest. These are all model performance, right? The model performance which are recorded on a daily basis. This is the model performance, right? So it is of futures which we've been doing. What's the max? So Abhi, did I answer your query? If not, do let me know. But synthetic future is we just now started, trading it, and it has got huge benefits. I will show it to you in the next slide. Let me just clarify the scaling up model first, and then I'll go there. And Raj Kumar has asked, what's the maximum drawdown so far with this model? So I showed you the maximum drawdown that so far we've gone to is in points term probably 1200 points, 1300 points. That's the maximum drawdown. But with this model, where for every lakh rupees you are scaling down your position size, your actual loss, realized loss, will go down with this particular fundamental, right? Even if you have a 1,000 point or a 1,500 point loss. So see, imagine this: you're starting with only 10 lots, right? 500 quantity. So which means that if your drawdown starts at the start of your trading itself, right? So your drawdown is on a lesser quantity, and if the drawdown keeps growing and going up, which means that, where is that? Let me show you the real thing. Yeah. So like in this case, right? So the drawdown is happening as soon as you started, right? So your position size is also reducing, which means that your total realized loss is also reducing, right? This is it. Let's say that you start your trading and your profit goes to 15 lakhs, and then the drawdown phase starts. It doesn't really matter to you, because what you're losing is what you earned, right? So your capital is still intact, right? So that's the power of it. So when you lose very less, because you're starting with small capital. When you have and when you start losing, when you have reached good profit, then it's not a problem to you at all, because you're losing only what you earned, which you'll gain back anyways, right? So that's my explanation to that. Yeah. Satish, please zoom while sharing Excel sheet. Okay, thanks. Yeah, I did that. Somehow the comments are not coming in by time. It's just randomly going anywhere. Okay. Yeah, Vinay, that's right. 1400 points maximum drawdown. Okay, Ruchit is asking, what if we don't use the scaling up technique and we use full 20 lakh capital on 20th May 2020? Okay, that's a good question, but I will have to do that calculation right now. It will take a little longer. So maybe I can send you the calculation later on, Ruchit. Yeah, I will noting it down, but it will take a little long to do the calculation. Another question, after we gradually scale down as per our drawdown, would that be a good idea to increase lot size while we hit the maximum historical drawdown instead of waiting to hit the new equity high? Yeah, that's a good thought process. I will cover this particular part in my next webinar, that how can you do um, drawdown based trading, right? Which is also called equity trading. But let's not confuse our methodology between two different thought process itself, right? Equity curve trading is a different thought process, and scaling up technique is a different thought process or a methodology. Let's keep the two, separate. And if we try to mix it, what happens is that your calculations go haywire. Yeah, you will start panicking if you enter or add up capital and start getting more drawdown. You'll start panicking and you'll take decisions which are probably not good for you. Right? You might exit on the wrong time, on the wrong trade. You might reduce further on a wrong trade, and suddenly the market will keep going up, and you will regret that why did you do this, right? So psychological impact happens if you do something which is outside the decided model. So Suresh, though that's a good idea, but that methodology is completely different. So you can probably allocate, let's say 10 lots for scaling up model, and you can allocate like 2 or 3 lots for equity curve trading, right? Which I will take another webinar on it. Yeah. Okay. So I don't have any more questions to answer. So I will move to the synthetic futures. Right? So synthetic futures is for those people who have been. All right. So I actually forgot. So characteristics of the scaling up model. Let me quickly finish that up. Scaling up is a fantastic multiplier, no doubt about it. Scaling up turns a good system into an extraordinary system, right? But if it is done incorrectly, then it can turn a bad or a mediocre system into a huge capital erosion. It can happen. Your capital will get eroded. So it is important that you trade scaling up model on a good system. So model one is a good basic and an average system which has very low drawdown over a period of time and keeps the equity curve as high as possible. Tries to model one actually it keeps the equity curve or breaks the equity curve high very often in 1 or 2 months, once in 1 or 2 months, right? Which means that it is a good system. Now, scaling up is a risky business, no doubt about it. That is the reason why we said that only utilize half of your capital and keep half of your capital always, right? And second thing that we said is that withdraw 50% of your profits, or 10 lakh of your profit, and then continue to go back to the base, right? So we are, though since it is a risky business, risky model, it has got fantastic scaling up or multiplier factor, but it also has low risk or a drawdown capacity because we are reducing the position size as well, right? But having said that, you should be aware that there is always a tail risk. So always hedge a tail risk. Right? So the one way that you can hedge your tail risk on the upside. Let's say that there is a circuit on the downside or a circuit on the upside, right? How do you manage that? So my suggestion here is at 700 to 1000 points away, Nifty, let's say that if it is trading at 17,000 now, uh, buy a call of 18,000 and buy a put of 16,000 all the time, always, right? You can buy 1 month before or 45 days before. You buy a monthly call or put, and then forget it, right? Forget it. Don't worry about it. You lose around 20-25 points either side. It's okay, but you will always be hedged against the tail risk, right? So that is one thing that I wanted to talk to you about. Yeah. Okay, what is synthetic future? Now this is important and this is interesting. I will actually go to a tool and then show you. So synthetic future is exactly the same as futures, right? Synthetic future involves buying a call and selling a put if you have to buy an index. Right? So if you are bullish, so what do? You buy a call or you sell a put, right? This is what you do if you are bullish, if you think the market will go up. But when you do both, you buy a call also and when you sell a put also, that becomes a synthetic future. The result is exactly the same as futures, naked futures. On the upside as well as on the downside, the result is the same, right? Irrespective of the strike price. If Nifty future is at 17,400, if you are taking a synthetic future of 17,400, it will be the same. 500, it will be the same. 300, it will be the same. For that matter, if you take 18,000, right, which is like 500 or 600 points away, it's going to be the same. If you take 17,000, which is again 500 points lower, it is going to remain the same. So irrespective of the strike that you select to trade synthetic future, the payoff graph, the upside and the downside will remain exactly the same as futures. Right? So this is a very big benefit of synthetic future because since it is open for any strike price, there is no limit to how many lots that you can trade, right? Which means that your orders will not move the market. Like in futures, if you put a lot of orders, like since our signals come, huge amount of orders go into the futures uh, market, right? But in options, I will be trading 17,300. You will be trading 17,400. Somebody else will be trading 17,500. So all these orders are spread across, and options have huge liquidity. Right? The spread bid and ask is in paisa, right? 10 paisa, sometimes 20 paisa. Right? So it's hugely liquid. And okay, another thing is that you can trade in weekly option or in monthly option. It is always going to remain the same again, right? And I will prove it to you. By the way, do you want me to explain things in detail on synthetic futures, or I think we are nearing an hour, so I'll quickly do it, right? So I'm going to a tool. Let me tell you. Okay, Nifty futures. So um, in one pane, so let's assume that I am buying a future, right? So I'm buying a future. So how will the payoff graph look like? Payoff graph will look like this, right? Now let me open up another tab, Nifty futures, and let me do a synthetic future. So the current price is 17,400. So I will buy a call and sell a put. One lot. See this. The graph is exactly the same as we saw in futures. It is exactly the same. And this is future. Yeah, it's the same. You see what I'm trying to say? It's the same. So your synthetic future is exactly the same as the actual future. So you can trade very easily with synthetic future. Now let me change the strike price, right? So 17,400 I took. Let me take 17,300. Yeah. See, this is the same. No change at all, right? Let me take 18,000. Right? Both call and put. Let me take 18,000. Again, it's the same. Doesn't matter at all which strike you change, right? So which means that you can trade synthetic futures in place of futures. Okay. You please keep posting your queries in the chat box. Uh, then I will answer them. Now, advantages of synthetic futures: no liquidity problem. Like I said, options have unlimited capacity. Synthetic can be done on weekly expiry as well as on monthly expiry. The results are always going to remain the same. Synthetic can be done on any strike price. Same results as futures. Charges of executing options is very less, right? It's very less. I will show you in the next slide how much you can save in synthetic futures. The higher you go up on the lot size, the more benefits, the more savings you have. The closer you come to expiry, lesser will be the charges, while the performance, the up and down, will remain the same. Why the charges will be lesser closer to the expiry? Because the premium is less, and the lesser the premium, the charges are even more lesser. Right? Disadvantages of synthetic futures is execution is not that easy as futures. So it is not difficult, but since it involves two legs, buying a call and selling a future, it's not that easy to, you know, take a trade and then exit it and then go on the short side, right? So execution is a little, but there are solutions to that as well. Also, if you're trading weekly, right? So every week we have to once do a rollover. So rollover is easy. You will figure that out. That in the next trade on the last expiry, if you can just simply take the next week trade, right? Now, how to execute? So execution can be done. So there are basket orders now. All providers have basket order features. Zerodha has basket order feature and all those things, right? So you can kind of use basket orders, or there are some tools like stock developer. We use stock developer. Then there is swasticalgo.com trading machine. All of these have one-click feature of executing these kind of multi-leg trades. Right? Or you can use Sensible. Sensible also has multi-leg one-click trading. So there are multiple methodologies, and these tools are pretty cheap, right? Swastik Algo and all will charge you like 1 month 500 rupees, 400 rupees, or something like that. I don't remember. So you can use these tools, or you can use Basket, or you can use Sensible to execute these trades. It's not going to be that difficult at all. So let me answer some few questions. So if spot or future is at 17,425, then what do we do? So we can take 17,400 or 17,500 for maximum benefit, right? ATM is maximum benefit because the premium on both call and put will be as less as possible. If the trade moves 200 points or 400 points, right? So let's say that the buy trade came at 16,900, and now market has moved up because once in a while that will happen. 17,400 it goes to. Now what do we do? You don't have to do anything, right? Let it run because the returns on both the sides is absolutely different. You can wish to roll the strikes up. That's also fine. You can do whatever you want. You can roll it up. You can let it run. Exit on the next signal. Do whatever you want. It's not going to matter at all. But my suggestion is that try to keep as near at the money as possible for maximum benefits from a pricing perspective. Yeah? To reduce the rollover issue, we can take far off expiry. No, you don't do far off expiry. Reason is that liquidity in far off expiry is less, number one. Number two, since the premium of far off expiry is very high, so the charges will be a little higher. So you want to take benefits of the difference in the charges, which you'll see in the next slide. So better to trade the weekly expiry. Which expiry to take? Take latest running for maximum benefit, right? If you want to roll over, then you should roll over on Thursdays. You should roll over before 2:30 p.m. Uh, or around 2:30 p.m. you can say, when the volatility is low. So on Thursdays, if you see from 10 o'clock to 2 o'clock, the volatility would be very high. Then suddenly the volatility will drop, premiums drop, and everything happens. The people are winding down. People are, you know, reducing their positions and all that. And from around 3 o'clock to 3:20, 3:25 again, the options price move very fast, right, up and down, because a lot of people are executing trades. So that's not a good trade. So try to roll over between 2 to 2:30. Just some rule you can follow. If I take monthly, then monthly premiums are more. So that's the reason. We want to take maximum benefits of the charges. Also, you may experience slightly higher slippages during the start of the month. That this slippages issue will happen in monthly expiry, because the volumes are not very high in monthly expiry, because people are trading in the weekly expiry. Right? I hope that's clear. If you have any query, do put in your chat. All right. So what are the savings in charges? Now this is interesting, right? So if you see, if you're trading one lot, in futures you will pay 192 rupees. In synthetic you will pay 120 rupees. Your savings is 72 rupees. Percentage saving is 38. If you are trading now, why the reason why I took synthetic futures as a second part is because now you'll start appreciating the benefits of synthetic future if you trade the scaling up model, because you are going to be starting anywhere between this 200 quantity to 500 quantity, and then go all the way up to 1000 quantity. In our performance sheet, we have considered 20-25% as slippage, but your slippages and your transactional cost and everything reduces to less than probably 5%, right? So you'll have more benefits if you use synthetic futures. So if you're trading 500 quantity, your futures per trade charge is 1500. Synthetic futures is only 360 rupees. Savings is 1100. This is huge per trade, right? Percentage savings 76%. And as you go higher, you will see the percentage savings are low. And you can actually, can you show a trade comparing index futures and synthetic futures? Yes, I will. Yeah, I will do that. Right. So you see the savings, percentage savings, huge percentage savings. And let me tell you, we have already moved all our clients to synthetic futures. We have run it for 5 days, I believe, and I will be showing you the order sheet of that. So this is the saving here. If you have any question, do let me know. Have you considered deep in the money ITM options around 4? No, I have not, and we should not. Right, because deep in the money with 1000 points, what's the benefit? Because the profit and loss is going to remain the same as futures. I hope you're asking about deep in the money synthetic, right? The profit and loss is going to remain the same. But if you are trading 1000-point premium option, just go and calculate the charges that you will be paying for that. Right? So there will be no benefit between synthetic future and futures if you are trading a very high premium option, right? We want the charges benefit. We want the saving, 60-70% saving in the taxes that we pay to the government and the brokerages that we pay to the brokers. So we want this savings, and this savings, for this saving to happen, you have to trade near at the money or near the money options to the futures. Right? So that's the question. How did you incur positive slippages in the synthetic future? I will show you the slip. Yeah. Got it. Brokerages are much lesser with synthetic futures near the money. Yes, brokerages are very, very less in synthetic futures. Right? So here is a real trade comparison. Let me open up the sheet itself. So first of all, trying to compare the slippages is too early right now, because we have been trading synthetic futures in our real accounts just recently, right? So not much of experience we have right now on synthetic futures execution, the slippages and all. But Whatever we have only for 5 days. So this is the real download from Zerodha order sheet, right? And these are all real prices and all. And this is how we, finally set it up in per trade. So this is one trade, right? So having analyzed it, this is what we've come to. So if you see in this particular trade, so this is all from the performance sheet. If you see the model point is minus 61, in real account we got minus 62, which is only 1 point more slippage. 1 point. If you consider futures, if you check your own performance, you will get 3 to 4 points minimum slippage in each and every trade. Right? Buying side 3 points, selling side probably 2 or 3 points. Right? So I am using 5 points futures trade. So here it is only one. Here also, if you see, there's only 1 point, and this is real. This is coming from the sheets. All of this trade is actually coming from the Zerodha sheet, right? So 40 I got. You see this? You see this 40, right? You see this 62.6, right? So 62.6 approximately. Yeah, this is 39 point something. So here we got, sometimes we get big slippages, right? Here you see the 64. Here we got higher slippage than performance, minus 22 and minus 30. Here also minus 6 and minus 17. Reason is that for in our account we delayed our execution. Right? We got delayed in the execution. If the market moves very fast, then order punching and all it takes a little time, and then we got a delay in our execution. Probably that is the reason why we have a higher slippage here. But check out this trade, 101, right? Again, this is a positive, right? In model we got 95. Here I got positive slippage. I don't know which one it is. Yeah, this one, 101, right? So here we got 6 point positive slippage. Yeah, whereas future would have definitely gotten us 5 rupees, 5 points here. Here again the slippage is only 1. You see the benefit. So model performance is 44, but in real account we got 19 points plus 19, and probably in futures, a friend of mine told me that this thing was a little on a higher side, right? Probably it went into minus 5 or minus 10. But this is where the slippage comparison comes into picture. You see what I'm saying? Yeah. So these are the comparison of the real rate. But again, I'm telling you that this is too early to claim. Uh, let's pass a couple of more weeks to kind of uh, understand and identify the final, um, final, what do you call it? Slippage comparison. Okay. How did, I'll take a few questions. How to execute the trades in Zerodha? We have to close 2 strikes and might open new 2 strikes. So total 4 strikes. Yes, that's right, Rajkumar. That's right, 4 strikes. And these are these savings are after trading those strikes. Do you want me to show it to you? I will show it to you live on Zerodha. But we don't have much time. You can check it yourself on Zerodha brokerage. Uh, let me Zerodha brokerage calculator. You can go to Zerodha brokerage calculator here. Yeah. So let's say this is futures and this is options, right? 17,000 and this is 17,000 and this is 500, right? So for 500, the brokerage that you have is 1,500, right? Now let's say weekly expiry is 100 and weekly call is at 150, right? And you're trading 500 quantity, right? So one leg will cost you 180. 2 legs will cost you 360. You see what I'm saying? So here it will cost you, for executing 2 legs, it will cost you 360. Here executing 2 futures will cost you 1,500. It's a very clear cut comparison, and that's exactly what is there in the sheet as well. Yeah, here 1,500, 360. Yeah. So you can check it yourself also. Can you repeat about hedging tail risk? I didn't get that. Okay. So what I'm saying is that, uh, if we have to protect ourselves from, let's say, overnight circuit situation, which happens probably once in 20 years, so you don't have to much worry about. But it's, a lot of people are pretty scary about this situation. So what you can do is, let's say that Nifty currently is at 17,000, right? So what you do is, uh, you buy 18,000 calls, yeah, and you buy 16,000 put, right? So two benefits. One is that you will get hedging benefits since you're trading model one. So if you're buying, your synthetic futures, and if you have a put buy, so automatically you get a margin benefit. So 1 lakh rupees, your margin will go down to 60,000, right? So you'll get margin benefit in this. Number two, you'll always be tail hedged. Why 1,000 points is because the model has a maximum drawdown of 1,000 points, right? And the circuit is also sitting at around 10%, right? Which is nearly 1,700 points. So to take a midway of things, we take 1,000 points. So we can risk maximum 1,000 points on the model, and if we risk 1,000 points, no problem, right? In our risk management, even if we lose 1,000 points, we anyways will lose 1,000 points in our model drawdown. So it's okay for us. So that's the reason 1,000 points away call and 1,000 points put call. On the downside, you buy put. Buy preferably 45 days before, or even 30 days before is also absolutely fine. Or you can buy every week, right? So weekly puts are even more cheaper. So you'll get 1,000 points away at 5 rupees. So this will definitely become zero, but you're losing only 5 on weekly options, right? If you buy monthly on the other hand, uh, on the other hand, a friend of mine, again, Hitesh, did a research on this, that once or twice in a year, market moves more than 1,000 points, and your 25 rupee call or a put goes to 250 rupees. Okay, so you cover up your entire year's cost of hedging, right? If you continue to do this. So that's another topic, but this is the concept. So you buy, call, and put on either side. Okay. I no, we don't use basket orders, Rajkumar. We don't use basket orders. We use tools because we have multiple accounts to execute at the same time. So we use tool which I showed you in the last slide. We are using stock developer. So with stock developer, we can execute, and we have our Python programs, we have our Excel programs, with which we can feed in one time that this is what we want to do, and just on one click we can execute all the trades for all the accounts. Yeah, we don't use basket order, but you can use basket order. I hope that's clear. So with these tools, 4 legs at once we can execute. And let me show you the timing here. Right? So if you see the time, yeah. So all these four were executed within 1 second, because these are all single trades, right? In a gap of 1 second, these were traded. Yeah. So all 4 legs are traded at the same time. Okay. Okay. So that's about it. This was about synthetic futures. So we've done scaling up, and we did uh, synthetic futures. Please do move to synthetic futures because of the added huge benefit. We have already moved all our clients to synthetic futures. Right. One more announcement. A lot of people have always asked us that slippages are an issue, and the real model performance um, is not giving the right picture. So we have decided that every month we will publish our results by subtracting 100 points from the final result. So if the model is giving 350 points, we will publish 250 points, but that we will do it at the end of the month. Hope that may help a little bit, because we are very confident about the model. We are very confident that long term, things will be very, very good. So we are okay with reducing the model performance. Yeah. All right. So I'll just give 2 more minutes. Suresh, you have a query. Are you done with your query, or you want to ask anything else? Let me unmute you. I see a hand raised actually. All right. Great. Thank you. Anybody else who would like to raise your hand, or any question that you have? Do you want me to open up everybody, unmute everybody? How do I do that? I don't know. I don't know how to unmute all. Oh, okay. Okay, I'm unmuting all right now. If you have any query, do ask me related to synthetic futures and scaling up. You can unmute yourself and talk. All right. I also have answered most of the queries. I think I can see in the chat box. I've answered almost all the queries. All right. Okay. Thank you very much, guys, for attending the webinar.
Junai, sorry, Joy.
Yes, Suresh. Yeah, please go ahead.
Sorry, this is not related to the synthetic, but you have talked about one more model, which is buying two ATMs, 200 ITM, 2X, and selling one ATM, like before the synthetic. So do you, are you tracking that model? How that's good? Because I'm executing that model, but I'm not getting exact as synthetic future, but I see from the risk perspective that is very, very considerate comparing to the futures risk. So, and it covers the tail end risk as well. So I just like to know about your our opinion about that model as well, if at all you are tracking that.
Absolutely. Though I don't track it, but it's an amazing thing to actually do. Let me just share it on the screen for everybody to understand it as well. So here, what we are talking about is that instead of buying a future, rather what we do is we buy two in the money futures like this, right? 17,200. We buy two in the money, and we short one at the money, single at the money call. Right? You see? So this is how the payoff would look like. This will give almost equal to uh, uh, the profits would be almost equal to the futures. Actually, it is not equal. It is a little lesser. Let me tell you that it is not equal. But if you see the risk side is amazing. I mean, that's pretty limited. Definitely, you can do this, and this thing is pretty less also. What do you call the margins required is also pretty less, right? So yeah, this can be done. I am not tracking
it. Lesser points, but risk wise, yeah, okay.
Yeah, I'm not tracking it. I'm not doing it because you know what? We've done some analysis of our model. So model, has a per trade risk of about 60 to 70 points or sometimes 100 points. Right? So if the so the loss on a minus 70, 80 points or 100 points on this particular system and loss on synthetic futures is nearly the same. Right? So if we consider that small part, then not much of benefit. Second is, since it's got higher set of legs, it's not that easy to execute as well, right? So now you've got three legs to execute, two legs to execute, but with two quantities. So there is definitely benefit on the charges and costs as well. But yeah, that is one thing. Second thing is that uh, this is not kind of consistent across all weeks, right? So you can definitely trade this to multiply your account, no doubt about it. But there are very very minor disadvantages also. We can do that as well once we have. Uh, in fact, that's a good idea. Probably start with 500 points, 500 quantity, which is 10 lots, and when you scale up the next lots using these models, right? This set, right? So your risk of scaled up quantity will be much lesser. That also can be done. Yeah, Suresh. This was also another good way of doing it.
Yeah, thank you.
Yeah. All right. Thank you, Parag. Good that you liked it actually. So we will hold a few more such webinars on different ways of trading using this model or some other model, and which will definitely benefit you. All right. Thank you. Thanks, Vinay. All right. Thank you very much. You guys all have a very nice left small weekend, and we will all see you tomorrow. Thank you again. Thank you, everybody. Have a nice day.